Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation rate for the month of September, with the majority of economists predicting a 6.7% inflation rate. We got our answer first thing this morning, with inflation coming in hotter than expected at 6.9%, with the average core inflation measurement coming in unchanged from August at 5.3%. So 23% of viewers on this channel got it right.
You should have told me.
Given that, just a week ago, Bank of Canada Governor Tiff Macklem said the bank will be raising interest rates into a recession to get inflation under control, the higher-than-expected inflation rate all but guarantees the bank will be raising interest rates by 50 to 75 basis points at its rate announcement next week. The bank has been clear that they are not only monitoring the inflation rate, they are keeping a close eye on inflationary expectations, on Canadians' expectations of the inflation rate going forward. And those expectations, as the bank's recently released survey of consumer expectations shows, remain stubbornly higher and are continuing upward. So what I want to do today is go over Canada's inflation rate, take a look at this survey of consumer expectations, take a look at the most recent interest rate projections, and then discuss what to look for next. As mentioned, the Bank of Canada is set to make its interest rate announcement next week on the 26th, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get that update, but for now, let's get into this inflation rate. As mentioned, Canada's inflation rate for the month of September came in at 6.9%, 0.2% higher than was expected, and the 0.1% deceleration from last month's 7% is due in large part to a reduction in gas prices. Indeed, if we exclude gas and food, prices are actually up to 5.4% from the previous month's 5.3%. So, higher than expected headline inflation that is growing if we exclude food and gas prices are up this month. Prices are still rising, and Canadians know it. Despite the 300 basis points in rate hikes that we've seen since March, Canadians are still not convinced that the Bank of Canada is going to get the inflation rate under control anytime soon. According to the Bank of Canada's survey of consumer expectations, Canadians still expect the inflation rate to be around 7% in a year from now, over 5% 2 years from now, and still over 3% in 5 years' time. And this is a big problem for the Bank of Canada, as when consumers think that inflation is becoming entrenched, that prices tomorrow are going to be higher than prices today, they spend money today, creating more inflation.
Inflation expectations could become unmoored, and high inflation could become self-fulfilling. We can't let that happen.
And we've talked about this before on this channel. How many of you have bought something now because you thought it was going to be more expensive in 6 months, in a year's time?
Don't ask me about my business.
But it's not just inflation expectations that are concerning the Bank of Canada. It's the direction of those expectations. While long-term inflation expectations are down since the last time the Bank of Canada conducted this survey 3 months ago, short-term expectations over the next 1 and 2 years, are up since the last time Canadians were surveyed. So, despite 175 basis points in rate hikes since the last time the bank conducted this survey, Canadians are still not convinced that the Bank of Canada, that Governor Macklem, is going to be able to get the inflation rate under control anytime soon.
Have I ever steered you wrong, Jim?
We continue to expect that these factors pushing up inflation will be transitory.
Wait, what?
So in summary, headline inflation is at 6.9%, higher than expected. Core inflation, average core inflation, remains at 5.3%. A large reduction in the inflation rate is due to gas prices being lower last month, and gas prices are rising now. And inflation expectations remain high and going in the wrong direction. All in all, these are going to put continual pressure on the Bank of Canada to raise interest rates by 50-75 basis points at its rate announcement next week. But how high are interest rates going to go? According to the most recent projections, the markets and RBC are predicting a 4% policy rate by the end of 2022. That would be 75 basis points higher than we're at now. And the OECD just projected that we would see a 4.5% policy rate by early 2023. And after rates go to 4%, 4.5%, make no mistake, they could indeed go higher. Central bankers were no doubt concerned this morning when the UK inflation rate came in at 10.1%. This on the heels of the US inflation rate coming in higher than expected as well. So there's going to be a real concern on behalf of these central banks that laying off the gas too early, slowing down on these interest rate hikes, will erase all the progress that has been made on the inflation rate thus far. The last time Canada's inflation rate was even close to this high was in 1991, and that was at 5.6%. The lowest prime rate in 1991 was 8%, with the highest being 12.25%, when inflation was at 5.6, 1.3 lower than it is now. Our current prime rate is 5.45%, or over 2.5% lower than the lowest prime rate back in 1991 when inflation was lower. So there's definitely a lot more room for the Bank of Canada to raise rates in the coming months ahead. With that said, we're going to get a much better idea of the Bank of Canada's thinking at its rate announcement next Wednesday, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe to get that update, but for now, thanks so much for watching.